Right, well, let's get our panel in here to break some of this down with us. We have Gregory Daco, EY-Parthenon's Chief Economist, and Zach Griffiths, Wells Fargo Senior Macro Strategist. So first, I want to start by getting your reaction to this first interest rate hike since 2018. Obviously, we saw markets rallying ahead of the announcement. A little bit, just a little bit up on that announcement, though. What was already baked in at this point, and how do you see the markets reacting going forward? Gregory,
well, I think in general, what we're seeing is an environment in which the Fed essentially crystallized its hawkish pivot that has been telegraphed for quite some time now. So even in the dot plot, the median expectations of rate hike, we now have the 7 rate increases, 725 basis point rate increases that markets have been pricing in. So this announcement is essentially a non-shock from markets' perspective because it's essentially aligned with what so far had been priced in. I think what's going to be very interesting now that we have liftoff is going to be the pace of ascent. There's going to be a key question as to how smoothly the Fed can navigate its future rate increases in an environment where there is a lot of instability, and that instability has been exacerbated by the situation in Ukraine. The key point in terms of the Ukraine situation is that it seems that the Fed is looking more at the positive inflationary effect versus the potential negative drag on growth and economic activity. So it seems to be leaning in the direction of pursuing its pre-Ukraine war tightening plans as the inflation shock is likely to be greater than the negative growth shock.
And Zach, your reaction to 25 basis points increase, and how many do you think will be? We just heard Brian Chung say the projection is for 7 rate hikes this year. Do you agree with that consensus?
Our call is a little bit below that, and I'd say actually the Fed came out much more aggressive. And I think even though the market has been priced for around 7.5 to 8 hikes, when I get the sense of what the consensus call was for the FOMC to indicate, it was something more like 5 or 6. So that's a hawkish surprise to us. You see the curve flattening in the immediate aftermath. That makes sense. And I'd say the other key thing that we're looking at is the 2024 dot is above where they expect the longer run dot to be, which indicates they expect to move policy into restrictive territory by 2024. So I think the key here, and it's been evident for a while now, is their concern around inflation. The war in Ukraine is another inflationary pressure that they have to deal with, and inflation was already rising at a rapid rate before that. So they're very focused on inflation. This is a very hawkish Fed we have here, and that should continue to push yields higher and the curve flatter going forward.
Greg, what we also heard from the Fed is that they are increasingly monitoring the international situation as well. How much do you expect conflict to continue to be absorbed into some of the economic data that a data-dependent Fed is going to be monitoring for each of their upcoming decisions?
Well, I think it's always important to take a bit of a step back and look at the broad global context against which this shock is happening. We have an environment in which inflation is already at a 40-year high with a print close to 8% in February. We have an environment in which supply chains are already strained. We had an environment in which there was a lot of financial market volatility, and there was a hit to confidence from COVID fatigue and high inflation. That's the backdrop against which we're working. So the Fed is going to have to consider all of these elements, including COVID, which is still an issue, and we're seeing renewed waves across the world, including in China, which may exacerbate some of the supply chain strains. That's the type of environment the Fed is looking at. So the Fed wants to, on one hand, avoid a situation where it exacerbates the financial stress, the financial conditions tightening, but on the other hand, wants to show a credible hand because it is behind the curve in terms of raising interest rates. And so it will likely want to continue to proceed. I wouldn't exclude the possibility of trying to front load some of the rate increases, depending on how financial conditions respond to the first rate hike right now. So we have 175 basis points of rate increases in the median dot plot, but could there be an effort to try to bring those rate hikes earlier on with perhaps a 50 basis point increase at one of the upcoming meetings? That's a key question for the Fed.
And Zach, as we're looking at the markets, we're seeing that they're sort of heading towards session lows at the moment. I wonder what your take is in terms of how this means that it's being received in terms of recession fears versus perhaps stagflation, as you figure the Fed can only do so much, and you do have these other headwinds still, this uncertainty over Ukraine and what we might see from China in terms of supply chain problems as we're seeing COVID outbreaks there as well.
There's a lot to digest, and it's a very difficult time to be a central banker, but I'd say the reaction in markets makes sense. The Fed is going to be very aggressive, which is a difficult backdrop for risk assets when you consider just how much uncertainty is out there. So I think you probably could see a risk-off move for the next couple of days as the Fed is even more aggressive with its policy tightening than I think the market had anticipated. And it really shows that from an economic growth standpoint, the geopolitical concerns are really not going to deter the Fed from focusing more on this inflation fight that Greg makes a good point. They're behind the curve. They need to act aggressively. And I think some of the statement language that we've gotten so far opens the door to a 50 basis point rate hike at some point this year. It'll be interesting to hear how Chairman Powell positions all of this in his press conference. But I think the release so far indicates that 50 basis points is very much on the table.
Zach, we try to get into the best practices possible as looking out to future Fed rate hikes to also see how far out the markets may be looking as well. We already know that there's at least been one dissent and trying to get the federal funds rate increased by 0.5 percentage point, and that was in the form of James Bullard at this most recent meeting. But we had heard other FOMC members signal even prior to some of the international conflict that they would have been supporting a 0.5 point rate hike as well. And so at what point do you believe the markets, in continuing to look forward as far forward as possible, have to also take into consideration the risk that it is going to perhaps hawkishly ramp up and in an accelerating fashion, considering the number of FOMC members that were already in that position prior to this last couple of weeks?
I think it's going to come down to how aggressively and how soon they adjust the balance sheet. And that's something that they indicated we're going to learn more about in coming meetings. I was a bit surprised to see that in the policy statement itself. So it's definitely something we need to keep an eye on. I think they could counterbalance rate hikes with more aggressive balance sheet policy, and that could set aside the need for a 50 basis point rate hike. But I think the Fed probably waits. Obviously, they didn't go 50 basis points in this first move, maybe waits at least one other move to see how the markets respond, to see how the curve reacts. If we end up inverting before the Fed gets a chance to raise 50 basis points, that probably takes it off the table, and maybe they ramp up more on the balance sheet side. But I think they're going to wait maybe another meeting or two, and 50 basis points could be something that we could see later this summer or in the fall.
Greg Daco, EY-Parthenon Chief Economist, and Zach Griffiths, Wells Fargo Senior Macro Strategist. Appreciate you both being here.